Hello and welcome to yet another episode of Decode with Shyam Sekhar. Today we are discussing a very interesting and hot topic, FPI exit from Indian equities. This seems to be a debate everywhere. Of course, FPIs have been on exit mode since the market peaked in September 2024, but this seems to have reached a crescendo in 2026 with foreign investors pulling out more than 2.2 lakh crores since January this year. At the same time, domestic investors have been pumping in money through the mutual fund route. So, this has triggered a debate on whether domestic investors are providing easy exit, easy liquidity for FPIs by keeping prices relatively stable. To discuss all this and much more, whether domestic investors are the hero or the villain of the story, we have Shyam with us here today, as always. Hi, Shyam.
Hi, I think the shoe is on the other foot. We are used to saying that the FPIs are the hero or the villain. So the narrative has done a 180-degree shift today.
Yeah.
I think neither is a hero nor a villain. Uh, I believe that the FPI move, which you're seeing today, is merely a reflection of what happened in our markets prior to September 2024.
Yeah.
We accepted the prevailing valuations as something that you have to live with.
Yeah.
And excessive valuations are not going to be lived with for too long when growth starts slowing down.
Yeah.
So, as growth has started slowing down in India's blue chip companies, which are all part of the large cap universe, the foreign investors became restive. At around the same time, you had the AI semiconductor theme coming up, and they were looking where to deploy money because they are not really participated in this. Even in US market, it was a concentrated participation. If you didn't own Nvidia, you were in dire trouble at that point. Subsequently, there was a diversification trade that happened in US also. So they bought so many companies. You've seen moves in Intel, Micron, numerous companies, right? Then they also wanted participation within the EM basket. And that's where the TSMC opportunity started looking brighter. And you have the two companies in Korea also, Samsung and SK Hynix, gathering a lot of attention. So it is essentially a shift from slow growth markets like India to 3 or 4 concentrated high growth bets in these markets. That's why the capital has shifted. Also, the Iran problem made several sovereign wealth funds which are in the Middle East sell. If they wanted to shore up their resources, because the countries needed that money for whatever, for rebuilding, stability, to source food, to keep the economy going, they needed the money. So when there is a sudden need for money, it's like a margin sale actually. If you want capital, you just sell. That is what has happened since March 1 till now, and it has been persistent. And once they started seeing the returns and the momentum building in the other markets like Korea and Taiwan, and they're also seeing the Mag 7 US market hitting new highs, I think the money just started flowing back, either into other EMs or into the US. This is not surprising at all. If FII see that India is again coming back, suppose the macro is going for one more reset, let's say the war ends or whatever, stability returns in the Middle East, and then oil prices soften, and then our macros once again reverse or regain whatever weakness it is now experiencing. In the sense, the weakness goes away and it regains its old status, right? Then what would happen is this can very well reverse also. We don't know. Unfortunately for us, around this time, the companies with a very high exposure to FIIs, like IT companies, are seeing a kind of a existential crisis, I would say. It is a crisis. Because clearly, what has AI done? Let's not go into the merit of investing in AI, but what AI has done is, it has created a very urgent need for business models to reinvent themselves. So I think that reinvention period, nobody knows how long it's going to be. That uncertainty is another trigger for selling. Having said that, all these FII actions are driven by their own compulsions and also by our macros, because when you see an oil price spike like this, our macros can become weak in no time.
Yeah.
And that has happened. So all these things have created a certain pattern of FII behavior. I am not unduly put out by this, nor I want to become alarmist seeing what they are doing. This is how they generally behave. Having said that, they could very well behave the other way around also if when the situation starts looking up.
True.
Now, are domestic investors giving the exit to FIIs? Now, you tell me, in this period from let's say September 24 till now, how much of domestic capital went into large caps? One. Second, how much of domestic capital went into large cap through other funds like multi-cap and flexi-cap? If you see, at least from what the data is saying, predominantly domestic capital has gone into mid-cap and small caps.
True.
That's not where the FIIs have shown urgency to sell. So where the FIIs have been exiting, they have been selling with high impact cost. It's not an easy exit.
Okay.
Your currency is weakened, and on a day you are selling, your stocks are down 4-5%. So your selling alone will carry an impact cost of maybe 8-9%. How is that an easy exit?
Okay.
I mean, are people really thinking through what they're saying? That's my fundamental question. And clearly the domestic institutional investors are not giving the FIIs the exit, though you are looking at headline data. They sold for this much, we bought for that much. That's not a way to look at it. See where the money. The money trail tells you something else. So I don't think that DIAs are giving such an easy exit to FIIs. If they're giving easy exit, then there won't be 5% fall, there won't be impact cost, there won't be so many things. Only thing is the rupee weakening is something that is happening because of the high frequency selling. That is, you're selling very fast. Because of that, and the money has to go out immediately. So large amounts of dollars are required every day. So that is putting some pressure on the.
So that brings in this question. Predominantly, this shift of retail investors through the mutual fund route coming into the market has been seen since COVID. Now, these investors are predominantly newer investors, and they are keeping the market afloat now. But assuming that the macros being as it is right now, India may still take some time to get back on the earnings growth front and all that. Do you think these domestic investors will remain sticky?
See, where is the other place where your domestic investor can put money? I know a lot of people are saying, oh, you should have invested abroad or in, particularly in the Mag 7. True. How much can you invest? You can invest maximum 10%. You cannot create a whole portfolio of Mag 7. It's not possible. So the extent to which investors could have invested in other markets is limited. Even now with all the gift city and all these things also, it's not very effective. Second thing, you need to deploy your savings continuously. The domestic savings pool is significant and growing significantly. So from here, I believe that the domestic investor will be the predominant player in the Indian stock market. We are at 20% of total assets, if I'm right.
19-ish,
nearly 20. And they are at around 18 or 17 or whatever.
14 or 15.
It's gone down further? Okay, fine. So slowly we are...
The intersection has happened in 2020 and
we
have, the divergence has started since then. Now it's about 5 percentage points.
It will keep on increasing, whatever. I think we will comfortably become higher. Where I feel a lot of people spending a lot of energy and I feel it is wasteful energy is telling the domestic investor, you are not a smart guy. You are doing dumb things. Okay. Personally, I think this is an ego trip. I think people are just saying this so that if the market goes down, they can say, see, I told you, I am a clever guy. But look at it from a saver's point of view. Anywhere in the world, investors invest in their country as long as they're confident about their country. They keep investing for a long period of time. Their investment pool grows because their savings pool is growing and they have a deployment compulsion today. And I would think that it's not a bad thing to have under the circumstance, because FIIs would have done what they do in any case. It's nothing new. But that we have become this sponge to buy is a good thing. Where we can be better, let me tell you. Where we can be better is being more valuation driven than being momentum driven. I think the domestic money at the origin point, don't go and blame managers. I think the investor himself wants that momentum. So investor is chasing the momentum, giving the manager money. When you give a mid-cap manager money, he is forced to buy mid-cap. When you give a small-cap manager money, he is forced to buy small-cap. You are refusing to give the large-cap manager money. So the momentum is not manager-induced. It is not institutional. It is actually retail.
So you are saying that the domestic investor is giving the money, but it will be a test of behavior for them once they...
Naturally, no. So I believe that actually Indian investor is smart. So far he has been chasing returns. But suddenly he'll switch and say, now I find these are all cheap. See, today, if you talk to a retail investor, ask him, do you feel IT stocks are expensive? He'll say no. Ask him whether he thinks private banks are expensive. He'll say no. Ask him whether public banks are expensive. He'll say no. He knows this. To that extent, the investor is actually well aware. Even an investor who is dependent on others on knowing what to buy knows these simple questions. If you ask him, is FMCG very expensive? He will say it's like what it usually is. And it goes down another 10-15%, he will know it is cheap. The investor is fully aware. So this awareness should translate in his behavior. No? Somewhere it has to translate. That is what it is showing. Little bit of greed is there. But that's human. He will always calibrate that greed, reduce that greed and go to the right place. If you're an investor who bought only small and mid cap for the last 24 months, would you just blindly continue to do that, or you'd see, hey, look at large cap, it's like one in many year opportunity, let me put some money. So you will try to rebalance, no? Because after all, we are opportunity seeking in our culture. Wherever it is cheaper, we want to buy. We are value driven, valuation driven. We didn't keep that discipline for some time, but that doesn't mean we are going to be perennially indisciplined. I think the discipline in the Indian domestic investor will come back, and when it comes back, he will go and put his incremental money in the right place. So
you feel the investors will get more and more matured in 100%. His or her thought process.
100%. How can you say investor will be immature always? See, this is a very paternalistic, condescending attitude that I find, whether it's coming from market voices of the past century. See, there are a lot of people who had glory in the last century. So their search for relevance comes from telling that the investor is a dumb fellow. I think it's unfair.
Okay. So this domestic investor participating more in Indian markets doesn't mean that we don't need the FPIs, or we would be less dependent on FPIs, is my understanding, because India does need the forex, and FPI is a large part of the forex flows that we get. So would the dependency on them reduce just because domestic investors, the share of domestic investors in the Indian market is increasing?
Personally, I think this will reduce if we are able to create massive net FDI. We are borderline negative FDI today. So you can't say when you're negative FDI, you can't say I don't need FPI. We need FPI. We need both. And we need both to believe in our country, and we need to do a lot to make both consistent in their India conviction. Right now, we are seeing high inconsistency, especially in FPI. Those who invested in India earlier are selling their equities through IPOs and then or QIPs and going out. Money is actually going out. So you are seeing hot money outflows, but what we need is steady inflows, which is patient capital. That money has to come. This money came 5-6 years back. That's why they are able to sell today. If they didn't put this money in the Indian emerging companies, which have all listed in the last 1 year, 2 years, which they are selling, then how would these companies have created this valuation? If FPIs did not put money in the Eternals of the world or Swiggies of the world when they were private companies, would you have created these companies? That's the question. So they have a role. Today they are taking the profit, saying that, hey, I did well, man, or I get at least, let me take what I have on the table. So that is why they are selling. I think it's every investor's right to sell. I don't think we should form a moral judgment about the companies or the Indian economy or about the investors. Somebody who bought a stock has a right to sell the stock. He thinks he can take this money and put it elsewhere. It's up to our ecosystem of companies and market participants to make the foreign portfolio investors interested in bringing money back to India. But it will happen, I think. See, because there are pockets where we are coming back. It should become more broad-based. Then suddenly you will see a reversal and money will come back. It's bound to happen. But point is, still it happens. No, what do you do as a domestic investor? Are you going to be nervous? Are you going to sell and get out and then say, I'll come back later? Or are you just going to consistently invest? This is the question. Now, we are already rubbishing these people. See, what are we saying? We're saying that the 30,000 crore SIP is dumb money. They will stop. They'll go out. Today, people are seeing that the net SIP has started turning negative. That is, if 100 rupees coming, 105 is going out. 100, I mean, SIP is stopping. See, all this is nothing but torturing the data to suit our narrative. The bottom line is we still have 30,000 crores plus SIP book. So you are getting 3.5 lakh crore from this. You also get 4-5 lakh crores of lump sum net into equities. So 7-8 lakh crores we are getting money. Now, today you mentioned 2.2 lakh crore, but I think close to 3 lakh crore has gone out. You have another 6 months. Even then, actually the two are balancing, if you see. So we need more FPI money coming in so that it helps us bridge the trade deficit. And the import should come down in different areas. So all this is happening. I don't think we should be so angry, pessimistic. There's no basis for this. In fact, I find the FII selling to be quite moderate. I'm not very, I mean, you're looking at the absolute number, but look at it in terms of the market cap of the economy. You're a 4.5 trillion market. So it's not so bad, I would say. It's not so bad at all. So suppose you're going to sell about, let's say, 4-5 lakh crores. It's not a big number. It's not a big number. It will bring the market back into a zone where somebody else will say, hey, let me invest in India. The valuations are all very attractive. All the negatives are factored in. The upside is not getting captured. So we have to go there. How soon we are going to reach there is the question. But I think that the smarter Indian investor will buy right up to that point and beyond also, because for him there is a need to deploy capital in a better asset class domestically.
Understood. So the other angle of having more and more domestic investors is also about investor protection and regulations and so on and so forth. So how do you see the market or the regulations evolving to prepare for a scenario where you have more and more penetration of domestic retail investor into Indian equities?
If you say regulation, you have to look at 2 or 3 things. First, you have to see what the RBI is doing. Okay, that is one level of regulation, because they control money as it comes in. They also control money as it goes out. So today you cannot send out money too much, and more controls are likely even in the LRS. So the RBI's regulatory oversight is fairly consistent, I would say. As far as the SEBI is concerned, SEBI mainly allows the market to take its own levels. There's no opinion on whether the market is cheap or expensive from the regulator. But regulator is constantly making it difficult for people to speculate, especially those who don't have the risk appetite. And the regulator is also doing risk management continuously and making the ecosystem safer. That's very clear. Now, going forward, we need to see how these reforms are going to benefit not only just domestic investors, global investors also, whatever changes are being done. I think it's a continuous process. So I think our regulation has been very cognizant of the risks. It's prepared. We are more proactive today than we are reactive, which is a good thing to say about current regulation. Everything is proactive, nothing is reactive. Earlier, what happened? Some problem will blow out of proportion, then everything will burst out. Then it will be only starting with the cleaning act and then going back. We are now doing preemption, which is very good. I think that's a good thing. Both the regulators are doing that. So I think that's a good thing.
Okay. So the other question is also about, which you lightly touched upon earlier. Now, usually, in the past at least, retail investors tended to follow what FIIs were doing. So if they would get into a particular segment or a sector, then they would get into it later on when it has already heated up. So today you see that FII is exiting large caps, so no domestic investor wants to go to large caps, and he or she is still been pursuing mid and small caps. The other thing is also about the sectoral rotation. As you did mention, a lot of FII money has gone out of IT, financial services, FMCG. Now, do you think there is merit in following the FIIs today?
So as an investor, I have observed what the FIIs do all these years. It's nearly 33 years since the first FIIs came to India. But I have not followed them into their decisions. Generally, what my experience has been and what I have seen the better investors or managers do is position themselves against the FIIs when the FIIs are irrational.
Okay.
Very simple. Now, today, are they being rational or irrational? I think they are borderline irrational. And they can become more irrational. So, between borderline irrational and highly irrational is a zone of investment. It's an investing zone. You need to invest. So, I think that is what the domestic investor needs to focus upon. I would continuously do that till the time the FIIs change their own glasses through which they see India. And when they do that, then it will become reverse and start going up. Right? So that window of time is not a bad thing actually. I think we should use it. I mean, you tell me, which is your best investment? The one you bought when everybody was cynical and pessimistic, or the one you bought when everybody was gung-ho? It would always be the former.
Yes.
Right? So today FIIs are taking out money for whatever reasons. It doesn't mean the Indian economy is going to die. It means that we need to balance our trade better. We need investment flows to make up for the trade deficit and put less pressure on the rupee. This is the problem you need to solve. And then over a period of time, this Iran problems will settle down so that we don't have to subsidize fuel, we don't have to subsidize energy, and the market starts absorbing it without contributing to too much inflation. So we are in this curve. And I think the entire curve of your journey, you're going to travel to this curve, I think you should be investing, not trying to second guess, trying to be the smartest guy, waiting for the brightest moment or the perfect moment. I don't think you should do all that. I think you just keep investing. I'm not saying this just to say that, oh, keep on doing your SIP. As an industry, we need it. Not like that. When the market is down and when investors globally are losing their confidence for their own other reasons, we who are predominant investors in our domestic economy should show higher confidence and buy the precise specific assets which are available at attractive valuation. So there is a need for a lot of precision that we need to demonstrate in our investing. I think this time is meant for precision, not for inaction.
Okay. So Shyam, we've been talking about the strength of the domestic economy in the light of a lot of global uncertainties, and that's probably why domestic investors are also seeing silver lining there and continuing to pour in money. But we live in an increasingly connected world, and global events, as we are seeing now, tend to affect us irrespective of whether you may be growing at more than 5% or 6% when others may be growing at 2-3%. So how do you only invest based on predominantly based on domestic factors?
No, I'm not saying that you should invest only in the domestic economy. I'm not trying to be jingoistic in this. But you should buy when the valuations are cheaper in the other markets. You should not chase returns after all the returns have been made. I think that today people rushing to US to invest in semiconductor or AI are doing exactly that. They did the same thing in Bitcoin also in the last instance. It didn't end well. Am I right? So I think that today you look around everywhere, everyone says you need diversification, you must go to US. I think this is a novelty trade. It is not a logical trade at this point. Same thing if done when the markets are down in the right places will be a logical trade. Now, if you are doing diversification, is it a novelty trade or is it a logical trade backed by valuations? I think at this point, I am not seeing the trade backed by valuation. If you look at the semiconductor related, bump up in these 4-5 Mag 7 stocks, they have no cash flows. Saying that they are cheap relative to the historic valuation is a wrong argument, because I think they are not generating cash for the kind of investment. The incremental return on capital on their current investments is grey or non-existent. So it's a hope trade at this point. Now, why would we go and put money into those companies blindly? Give it some time. Suppose that market cools down and you are also getting visibility that it's not a hope trade as people say. There is some merit to all these investments that are being made, and you can see returns coming on the massive investments that you are making. At that point, you can always go to that market. At any point in time, you must look to diversify in two ways. One is based on your asset allocation within an economy, based on your global asset allocation. So both should be done. But my sense is an Indian investor need not invest more than 15-20% overall, right? So what can you do? You could have done in China. You can do some US blue chips. You can do a little bit in NASDAQ when it comes down, or S&P 500. So all this can be done when the valuations are in your favor. If you see some other opportunity like a Korea or something when it was down, you can invest. Then you have the global mining funds. You have global, so many other thematics. So some of these thematics may be interested. So you can invest a little bit in them. But I don't see this logic of saying that I must own Oracle at any cost. I must own Microsoft at any cost. That logic, I think, is no different from what we did in the buy at any price trade between 2020 and 2024. It's not ended well. What if the same thing happens to your US portfolio, which you're building now very aggressively? That's a risk which you need to address now. You can't address it later. That's my simple point. I'm not against any of these companies. I'm not against global investing. But we should do it when it makes a lot of sense to us. When Buffett doesn't want to invest too much in his own market. Okay. Why should the Indian retail investor rush into that market at this exchange rate? See, you're having disadvantage of exchange rate. You're having disadvantage of valuation. So at least if you have advantage on one of these two parameters, then it makes sense to, start investing and building something. At this point, I feel you should be a little bit tentative and cautious. I am not saying that you should take an ideological view against overseas investing. I feel today there's too much FOMO. You just see the number of people talking about investing abroad in social media and see the tone. These two things itself is a very counterintuitive signal for you that you should be careful because it's selling. Why are so many people talking? Because people want to know. Even the other day, somebody said in one of the shows I was making in my vernacular, everybody says you must talk about global investing in this show. Everyone wants to learn about global investing. I asked my friend, you mean now? See, I bought Google at $120, $130, right? I don't want to do it at $390. At that point, people are pessimistic when you had that first slip up in AI. You remember the launch? That was the time to buy. Now look for time like that to buy globally. Look for opportunities like that. Don't go with a blind conviction and with so much of FOMO. So much FOMO, the fear of missing out with relation to this trade, it scares me. I'm not against it, but I would play it judiciously, very, very judiciously. And there are very significant part of the US market which are undervalued today. But our people are not going there. Clearly, they're not going there. They are going only where the hot money is. And I would be very careful. It could end up being a Bitcoin type of trade again. I'm very scared of that. I'm not against investing abroad, but judicious investing is the need of the hour. So, domestic, anyway, you have to invest 65 to 75%. So, only the balance 25 to 35% you can do outside of equity, outside of domestic equity. You can do it through assets. You can asset diversification. Asset allocation can help you diversify. Then geography allocation. So, there you can do about 10-15% in global. Today, I think except of one or two opportunities, the others are not looking so attractive to me. I would wait for the valuation to come into my zone of comfort to a better visibility, maybe closer to the US election midterm polls. I would take a view after that.
So you're saying you still prefer Indian equities to global
because
at this
they're becoming
point
cheaper
in time.
every passing day. It's such a simple thing to do, and you just keep investing in small driblets using this time. Over a period of 1-2 years, you would have put in money in the right place at the right time. Just make sure that you are doing that. And in the interim, if you get something globally, you can also put some money globally. I think it's a time to be less anxious, more precise, and very decisive in what we are doing. Though the decision sizes will be smaller. This is not a market for big bang. where you say, no, I'm going to do this, and then thump the table and jump and all that. Nothing. Just small incremental steps that you're going to take along the way until you find that opportunities are better for diversifying into other markets. Those incremental steps which you do, small, monthly, or frequent investments, are better off in the domestic market, driven closely by valuation, not by your
momentum.
Yeah, correct. So that is
Yeah.
that is what I think makes sense. And if you see, you look at all the investors and investment managers you respect in India, they are quite cool now. They are not anxious. It's only those who are performance marketeers who are having this anxiety. As an investor, how did I approach this in the previous situation when I was not a professional manager? I just ignored the performance marketing and stuck to valuation. Now, because I am also a professional, participating in this industry, it doesn't mean I need to change. I will still be the same because it makes sense to me and it's a safe thing for the investor, and it is something that will give us a very good investment experience when the volatility spikes up.
Yeah.
Right? So I should position myself for all these things correctly. And I think this is the way to do it.
Okay.
This is my conviction. I'm sure there are people who have other ways of doing it, but I think I would work this way, and I would like my investors traveling with me to have the same approach.
Okay. That was a conversation that did ease some nerves and put confidence back on worries over the never-ending outflows of foreign investor money from Indian equities. Ultimately, each investor or manager follows his or her own path to navigate the current global uncertainties and the market volatility. But investing always with an eye on valuation and not based on what's trending or where the hot money is going is what will fetch the results, is the key takeaway from this conversation. See you in the next episode of Decode. Thank you.